All right, so Dr. Oz is finding himself in some pretty hot water recently related to his income taxes. So Dr. Oz is a very well-known media personality. He was a cardiothoracic surgeon, a professor, and he did have a run at a Senate seat in Pennsylvania a number of years ago, but he lost that race to John Fetterman. Well, now he's back vying for a government role. He was nominated by President Trump to head up the Centers for Medicare and Medicaid Services. And so as part of that review process, they look over his financial disclosures, his tax returns. And in doing that review, they found that he received allocations of income from partnership interests where he paid federal income taxes on those allocations, but he did not pay any federal self-employment taxes. And so the issue at hand here is his defense is, well, I'm using the limited partner exception. So if we have a look at the memorandum prepared by the Finance Committee here, what they've done is they've outlined the review that they conducted and then the shortcomings or the issues that they have with the tax positions that he and his accountant took on his income tax returns. And so just for a bit of background, again, the central issue here is self-employment taxes, and then specifically that limited partner exception, which is nothing new. It's been used for many, many years, but it's getting a lot more controversy recently because the IRS and the courts find that too many partnerships are structured to simply avoid the self-employment taxes, and they're using the rules incorrectly. So a bit of background on the tax here as they've outlined. So there's a tax imposed on earnings from self-employment. So this is the Social Security and Medicare tax on self-employment income up to certain thresholds. Now, there are certain income exclusions from net earnings from self-employment, and including the share of income or loss of a limited partner other than guaranteed payments for services, and this is referred to as the limited partner exception. Now, the language in the statutes is silent regarding whether one must merely be a state law limited partner in order to exempt the income, or if the taxpayer must show that they have limited activity with the partnership. So what they're asking there is, you might call yourself a limited partner, and you might have a state law limited partnership with a GP and a number of LP units. You might be a limited partner, in form, right? The paperwork might say that, but this is more of a substance over form question. Is like, are you truly just a mere passive investor in this entity? Or are you actively doing something with the company that suggests it's not passive income to you, it should be non-passive income, and thus subject to the self-employment taxes? So the most recent case that came up within the last year or so is the Soroban Capital case. So if we have a quick look at that case summary, just to get a little bit more background here. So Soroban Capital was an investment firm, and it was set up in Delaware as a limited partnership. So not an LLC, it was a state law limited partnership. So there was a GP entity that was running the business, arguably, and then a lot of the individuals that also participated in that management company held limited partnership units in the Delaware LP. And the position taken on the returns for this company were that, okay, guaranteed payments and income allocated to the GP, that's okay if it's subject to payroll taxes, so the self-employment taxes. But any allocations of income sent to one of the managers in their capacity as a limited partner, so holding LP units, that was subject to federal income tax, but not self-employment tax. So the SECA did not apply to them. Now, the IRS challenged this, and it went to trial, and the tax court agreed with the IRS. They said that, look, we understand that you've set this up and that you are a limited partner in a state law limited partnership, but more of a substance over form issue is what activities are you actually conducting within the business? You can't be actively participating in the business and just throw a limited partner label on your allocation of income and get away with not paying any self-employment taxes. Well, what the position that Dr. Oz took and his accountant did is quite similar. So they have some partnership entities set up. So the first entity, Oz Property Holdings LLC, it's set up as a media company which owns Oz Media LLC and Show Production. Now this entity here, Oz Property Holdings LLC, is not a state law limited partnership. It's a state law LLC, but it is taxable as a partnership for federal tax purposes. And so on the returns, if we look at the 2021 return here, for example, Dr. Oz received $3.6 million from Oz Property Holdings LLC as ordinary business income. He did not receive any guaranteed payments, and he did not report any of that income as subject to SECA. Now, he also did not pay 3.8% Medicare taxes on the ordinary business income either, and so they think the total understatement in taxes, had they been subject to SECA, and that net investment income tax would have been $138,000. And then the same issues apply for the 2022 and 2023 years. So in 2022, he had $6 million in ordinary business income from Oz Property Holdings LLC. No guaranteed payments for that year either. And so as a result, none of that was subject to SECA. The 3.8% Medicare tax also wasn't imposed. And so they estimated about $228,000 in additional taxes that could have been imposed. Now in 2022, he did have a W-2 reporting a little over $9,000 of earnings. Now, as an employee, that W-2, that would be subject to Social Security and Medicare tax. But you could argue that that would not be a reasonable salary, right? That's significantly less than probably what he should have been paid. And then again, same issue for 2023. So he received a little over $950,000 in ordinary income from Oz Property Holdings LLC. No guaranteed payments either. And as a result, none of this income was subject to SECA. At least that's how they report it. And so then they estimate again, as far as the understatement in federal self-employment taxes was a little over $36,000. Now, his response and his accountant's response is, again, falling back on this limited partner exception. They believe that they set it up in such a fashion where, okay, he might have a multi-member LLC. He has a general partner interest, maybe another management company. So any income flowing through there would be subject to not only federal income tax and the SECA, but his holdings in the partnership in the capacity as a limited partner would not be subject to federal self-employment taxes. Now, as I highlighted here, the position is counter to the position of the Department of Treasury, right? And so that's obvious, right? I mean, if we look at the Soroban Capital case and a number of other cases, right, the position of the IRS and the Treasury Department is you can't just place labels on your holdings to try to avoid these kind of taxes. If you want to be exempt from federal self-employment tax on your allocation of ordinary income from a partnership, you actually have to be a limited partner in that this is just a passive activity to you. It's not a non-passive activity. All right. Now, he was asked, would you amend your returns, to restate the income as subject to SECA? And he said, no, I'm not going to amend it because we've done everything according to the law. No sense in changing it. Now, this is one of those things where some companies, some tax advisors and preparers will continue to use that limited partner exception, right? They still fall back on the form rather than the substance of the relationship, it's starting to look like that's a bit more of an aggressive position to take. The more conservative position would be, okay, look at the facts and circumstances of the arrangement. Are you actually a limited partner in this entity in that you put in some capital, but you're not spending your time with the company? You're not making management decisions. You're not doing anything to help generate revenue for the business. You really are just a limited partner in that you contributed some cash to this business for an ownership interest. You receive an allocation of income, some distributions, and that's it. So in his position, he definitely has, in my opinion, an uphill battle here to try to contend that that's an appropriate tax position to take, because if it's his company, and it would depend on how many other people are involved, but he's clearly the face of the business. He's the one that's generating the revenue for it. And so for him to take this position that none of those earnings allocated to him as a limited partner would be subject to SECA is probably not very reasonable. But, like you said, they think they did everything right. They're not going to amend the returns. I'm sure if the IRS takes a closer look at it, maybe they would have a different position. But very, very interesting. And obviously there's a bit of an irony element here, considering that he's going to be heading up the Medicare and Medicaid Services, which is a department that is directly funded by payroll taxes, right? So payroll taxes, Social Security, Medicare coming out of your wages as an employee, or if you're self-employed and you have to pay those at the end of the year on your own, all of that money gets pooled and put into those programs to fund those kind of services. So interesting development for Dr. Oz. We'll see what happens during his confirmation proceedings, or whether or not he actually gets through. Taxes, the tax profile there, it certainly doesn't look good for him, but maybe he'll be able to weather the storm. All right, so that covers it for this update. Hope that was interesting. And as always, I appreciate you watching and look forward to seeing you again on the next update.